Hello, everybody. This is Professor. This is the accounting prof. I don't even know what I am anymore. But this is Bennett Tchaikovsky, also known as the accounting professor here on YouTube. I This presentation is copyright 2008 through 2024. All rights are reserved. Any distribution or redistribution is expressly prohibited without my prior written consent. Opinions expressed herein, and including terrible dad jokes, are those of myself and do not represent those of Irvine Valley College or the South Orange County Community College District. So here we are. This is basically part one, where we'll be going through and working through a real live trial balance and trying to go through and figure out this part of it. So I've tested this type of question a lot of different ways. The way that I kind of like to kind of go through, though, and test is to basically start students off with an unadjusted trial balance. I have examples where I've gone through and I've like basically listed out transactions for the students to record, but I like doing it this way because, we're getting right to the heart of the matter, which are doing adjusting entries. So when we look at these items over here, I've essentially covered these in different videos, like the loan payable, loan receivable, the equipment. So what I'll do is I'll go ahead and do links below to these other questions in this series. And I will also include the other part of when I did a question that was a lot more simplistic. But what's going to be different about this question is we are going to go through and prepare adjusting journal entries. We're going to prepare an adjusted trial balance. We're going to prepare an income statement, prepare a statement of retained earnings, close out the temporary accounts to retained earnings, do a post-closing trial balance, and then prepare a classified balance sheet. So as we look at this, the way we want to approach this question is that, oh, we have a loan receivable over here of 180. Now, if you're taking my class, and I list it out below, then you're going to need to do an adjusting journal entry. There's like no question about it. You're going to have to. So let's go through and kind of peel back each one of these. So let's borrow some T accounts. So when I have a loan receivable, right? Basically, I've loaned out money. Even if I have not yet been repaid the amount, I need to record interest revenue. So the way I'm going to go through and do that is, well, how do we go through and record revenue? So the way you're going to do it, we record revenue with a credit. Now with a loan receivable, and let me just take a quick break here and just show you something. So if you look at some of my prior videos or my prior, things I've done, one of the ways is that when you get any type of an initial transaction, this is basically going to be the adjusting entry. And it's really a matter of how many times can you go through and practice, right? Because when you get to my exam, you know that this is kind of the universe I'm going to be able to ask you about. So let's go through and take a look over here. So when I have a loan receivable, even if I'm not being repaid the interest right away, I need to record interest revenue because I've earned it during that time period. So I'm going to be crediting interest revenue and I'm going to be debiting interest receivable. Okay, so very important. Debit receivable, which is an asset, credit revenue, which is a revenue. You'll sometimes see this referred to as interest income. Now, how much do I record? Well, I have a loan receivable and I dropped the zeros, right? So this is 180,000. My interest rate is at 10%. So my annual interest is going to be 18 or 18,000. But for every debit, excuse me, it's not for every, wow, I'm really losing it. So how many months was the loan outstanding for? Well, Bennett, it was outstanding for October, November, and December. So coming over here, this is going to be times 3/12, or 10/1/24 through 12/31/24. So when I multiply this through by 3/12, I get to 4.5. So over here, I'm going to debit interest receivable. I'm crediting interest revenue. Okay, so how do I record this as a journal entry? Well, over here, if I've done the T account, debit interest receivable, I'm going to credit interest revenue for 4.5. Now notice over here, the credit is indented. Therefore, the account name needs to be indented. If you put it flush and you're in my class, you'll lose points. I need a date. All my adjusting entries are going to occur at the very end of the period or on 12/31/24 to record interest revenue. Right? As long as you don't say something crazy, I don't know what crazy would be, but as long as you're just describing the transaction, that would be perfect. And let's go to the next one. Okay, now what I can also do too, if I choose to do so, is I can kind of come over here and start working on the adjusted trial balance. And what the way we would go through and do this is like, okay, how would I basically start going through and booking things in? Well, if I look at this here, I've got interest receivable. I'm going to put that under the loan receivable. And this is going to be an adjusted debit of 4.5. For every debit, I need a credit. I'm going to put down here interest revenue of 4.5. Okay, so I'm just putting that up into the adjusted trial balance, and we'll show you how this works at the very end of this video before we go on to part 2. So now I bought equipment, and there was equipment that I purchased for 140. So coming right over here, the equipment was purchased for 140. It was bought on 5/1/24. The equipment has a 20 salvage value and a 5-year useful life and will be depreciated using straight line. So again, there's a video I have going through how to record depreciation expense. When we record depreciation expense, meaning that I've gone through and I have been using the equipment, the adjusting entry is always going to be the same. Debiting depreciation expense, crediting accumulated depreciation. So I'm going to debit depreciation expense. I'm going to credit accumulated depreciation. Now, my formula for straight line is my acquisition cost minus my salvage value. And this is going to be divided by the estimated useful life. And this is going to give me my annual depreciation expense. So my acquisition cost was 140. It has a salvage value of 20, 5-year useful life. This is going to be 120 divided by 5, or over here, 24,000 is going to be my annual depreciation expense. However, this is the annual number, right? I did not use the equipment for the entire year, right? So over here, how long did I use it for? May, June, July, August, September, October, November, December. I used it for 8 months. So 16,000 will be my depreciation expense. Remember, when we're going through and recording our adjusting journal entries, extremely important. We have to be able to go through and answer these questions, right? Do our revenues reflect what we've earned? Expenses reflect what we've used? Assets reflect the future economic benefit, and do our liabilities reflect our future obligations? After I do this journal entry here, my interest revenue reflects what I've earned for that period. My interest receivable reflects an amount that's owed to me. When I record depreciation expense over here of 16, this is reflecting what I have used during the period. Remember, annual depreciation expense, or basically from 1/1/24 to 12/31/24 would have been 24,000 if it was for a full year. But I purchased this equipment on May 1st. Therefore, when I'm going through and doing depreciation, I can only depreciate it over the time I've used it for, or a total of 8 months. And that's why we're multiplying this by 8/12. So I'm debiting depreciation expense and I'm crediting accumulated depreciation. Now, when it comes to writing this out, I can also go through here and say AD equipment, which is absolutely fine. So in terms of doing the journal entry format, we follow the same thing. I generally want to list out my debits first. I'm debiting depreciation expense. I'm crediting accumulated depreciation on the equipment. This is a contra asset account. I did a lot of explaining in the video. You can find it below when it comes to equipment. Strongly encourage you, if you're looking at this thing, dude, what are you talking about? Go back to that video. You'll have lots of fun watching. So this will also be as of 12/31/24, but I'm not done. I need a description to record depreciation expense. Okay. Now I'm going to go ahead and put this up into the trial balance. So over here, I'm going to have accumulated depreciation on equipment. Remember, this over here is a contra asset account. It's going to reduce the carrying value of the equipment. Show this over here as equipment for a credit for 16. And I'm going to debit depreciation expense. And again, I'm doing this over here in my adjusted. I'm going to put a darker line right here just to basically make sure that we're keeping things separated. Okay. All right, so we're doing this right over here. Okay, so total debits, total credits, we're good so far. Let's go ahead and look at the next one. Okay, the unearned revenue relates to an advance received from a customer on 3/1/24. We perform the services for the customer at a rate of 18 per month, beginning on 3/1/24 through 12/31/24. Okay. So let's take a look at this here. Unearned revenue. My unearned revenue had a balance right over here of 360. Okay, so it had the 360 credit. Now, when I look at this as pre-adjustment, when I'm looking at this, what I need to kind of say to myself is, okay, I've performed the services at a rate of 18 per month from March 1st through December 31st, or March, April, May, June, July, August, September, October, November, December, 10 months. So 18 at 10 means that I need to have consulting services revenue for 180. So I'm going to have consulting services revenue. I'm going to basically record revenue because I have to, because I've done work, right? And so I'm crediting consulting services revenue. This is from 3/1 to 12/31, or 10 months. Over here, this is 18 is my monthly rate. Now, when it comes to this part over here, for every debit, I need a credit. Now, when I go, for every credit, I need a debit. The account I'm going to credit is basically going to be my unearned revenue. And so I'm going to debit unearned revenue. Okay. And if we look at this right over here, my unearned revenue account now has a balance of 180. Does that make sense? Well, if we had a total of a 360 advance in terms of unearned revenue, and I was basically performing, so my total advance or unearned revenue, and my rate per month was 18, this would basically be giving me a total amount of unearned revenue of 20 months in advance. So here I've had 20 months of an advance. I earned 10 months earned, and I have 10 months remaining obligation. So my unearned revenue balance needs to be 10 months times the monthly rate, or 180. When I record the revenue here, and then I'm going through and debiting the unearned revenue, my ending balance in unearned revenue is correct. So to go through and to do this as a journal entry, right over here, date 12/31/24. I'm going to have over here, start over here with my debits, unearned revenue, 180. I'm crediting consulting services revenue, and we can just call this to adjust to record consulting services revenue. That's all we're going to do. In real life, this would be very, very different because we're going to have within our accounting system, we're going to have a bunch of different client accounts. So it'll be done differently. So I'm going to wait on this really quickly because I have another revenue transaction that I need to kind of go through and deal with. So I'll come back to this momentarily in terms of recording it in the T accounts. So over here, the loan payable. So my loan payable amount was 120. So the loan payable represents money borrowed by DDI on 4/1/24 at an interest rate of 6%. The loan and interest will be payable on 3/31/30. Now, if I come over here and I say to myself, okay, I need to go through, and how do I go through and adjust basically for a loan payable? Well, again, if I have a loan payable, meaning I borrowed money, and I'll put the link to the video over here, the adjusting entry is always going to be the same, or it's going to be a debit to interest expense, and it is going to be a credit to interest payable. Okay. Now, in terms of the amount of interest that I owe, the loan amount was 120. My interest rate was 6%. So my annual interest, whenever you see an interest rate, it is always an annual rate, is going to be 7,200. However, over here, I borrowed the money on April 1st. So the adjustment, I only basically from 4/1 to 12/31, this is April, May, June, July, August, September, October, November, December. So 9 months. So this is going to be 9 months. So I'm going to multiply this by 9/12 because I didn't use the money for the full year. Times 9 divided by 12. This is going to be 5,400. Okay, so how do I record an expense? If I've used money, I'm going to record that expense with a debit. I'm going to record that liability with a credit. So coming over here to do a journal entry, 12/31/24. I show my debits first, interest expense at 5.4. I'm crediting interest payable at 5.4 to record interest expense. Okay. So I've done this part over here. Now I'm ready to go through, and I'll go ahead and put this into the T accounts. I didn't do this one up ahead, but we'll get back to that momentarily. So over here, I have interest expense for 5.4. And I'm going to have interest payable as a credit for 5.4. Note what I'm doing here. I'm including the interest receivable with the loan receivable. I'm including the accumulated depreciation on the equipment with the equipment. I'm doing this intentionally so that when I prepare financial statements, my life is going to be a lot easier. Let's go ahead and go to the next one. Last one, I perform services for a new client amounting to 17,000. However, I did not invoice the client. So over here, we had an existing balance in our customer consulting services revenue of 180. We also had a balance over here in our unearned revenue of 180. So it's going to put these accounts together. Now, over here, when it comes to consulting services revenue, it doesn't matter whether or not I've been paid, rather have I performed the work. Here, I performed the work. So how do I show that? Basically, I'm going to go ahead and we're going to say this is 17, not 17 million. Okay, so this is me at 17. So over here, I'm going to credit consulting services revenue for 17. For every credit, I need a debit. I can't debit cash. I can't touch unearned revenue because it doesn't have to do with that. It's a different client. So over here, the client owes me. So I'm going to call this accounts receivable. And this is going to be over here for 17,000. And on the first exam, which again, I'll go through and leave those below. If we perform services and haven't been paid, this is how you go through and record it. Okay. So looking at this, my consulting services revenue, I'm going to go ahead and combine it with this one right over here. And when it comes to doing a journal entry, I'm just going to record the transaction I just did. So this is going to be 12/31/24. I'm debiting accounts receivable for 17. I'm crediting consulting services revenue for 17 to record services performed. Okay. You also say to record consulting services revenue. That's absolutely fine. Now I'm ready to go through and record this, and I'm a total moron because this needs to be a debit to accounts receivable. I perform work that I have not yet been paid for. So let's go through and put all these accounts in. So my accounts receivable, or AR, is at 17. Over here, my consulting services revenue is at 197. Now, over here, this will be a little bit funky. My unearned revenue is no longer 360. My unearned revenue balance is now going to be at 180. Okay, so coming over here, unearned revenue is going to be at 180. Now, to finish off my trial balance, all I'm going to go through and do is pull the other accounts that I did not go through and adjust. So I'm just pulling over the balances that I did not adjust. And when I do this, what I am hoping is that my total debits will equal my total credits, and they in fact do. So I have done this part correctly. Now you'll sometimes see in different accounting books, you'll basically see a step. You'll see debit, credit, or unadjusted. And then you'll see a step of like adjustments, and then you get to the adjusted. I'm just kind of blending them in together. It's whatever you really choose to kind of go through and do. But when we do go through and do this unadjusted trial balance or this adjusted trial balance, we want to make sure that we're following assets, liabilities, owner's equity, dividends, revenue, and then expenses, right? We want to kind of follow that pattern because when we come back momentarily and start up the financial statements, we want to make sure that we have that in place. So we've done 1 and 2. We're going to come back and do the rest just momentarily. Have a great rest of your day, and I will see you on the next video.